Welcome back. You're tuned into Bazaar Morning Call. As promised, we have Dharmesh Kant, Head Research, Chola Securities, who joins us on the show. Hi, Dharmesh. Good morning. Good to see you in. Well, SBI's numbers look very, very strong. What's your view on the stock? It's already had a good run. It's outperformed. But with these numbers, you think there's scope for it to give better returns from here?
Yeah, very good morning to you, Nigel, and thanks for having me for the show. Yeah, the numbers were really excellent on the SBI. On any parameter, if you look at it, be it retail growth or the agri growth, the corporate loan book also grew by 13.5%, and credit cost was controlled at 0.29% with lower slippage, and asset quality improving. We discussed this number around Friday around the closing trades, and I was working with around 8% kind of PAT growth. And the number came in line. I mean, adjusted PAT growth, if you strip off the dividend and other income, that is forex gains and last quarter Yes Bank numbers. So it was pretty much in line. Sequentially, it was 8% growth and 7% on a year-on-year basis. Street was working with around 4% kind of a growth because of higher provisioning, which came lower, and at the same time, the other income also grew. Management was sounding very bullish and confident about this run rate to be maintained. And going by the way that things are happening, if you compare it with other larger peers like HDFC, ICICI, so the performance has been really stellar on the SBI account. Considering 47 lakh crores of advances are sitting on the book. So 16-17% kind of a growth with help from the corporate loan book spending is gettable. We are working with an EPS of around 100 to 105 rupees for FY27 and valuing the company at say 1.8 times price to book value 1 year forward. The target price is around 1240. So 15-16% kind of headroom is still there for SBI to gain traction in the medium term. The only caveat was that management sounded a bit conservative on the NIMS fund, where they said that cost of funds will not come down going forward because the asset side, the transmission has happened, whereas the liability side, they don't see any further transmission happening. So deposit rates and PASA and the short-term retail lending rates are going to stay where they are. So that's the 3% is the news where they said exit for FY26. I think the same is likely to be there for FY27. So net value buy, any decline should be bought into, and maybe 1250, 1240 should be a likely target in 6 to 7 months kind of a time frame.
Just one follow-up, Dharmesh. Even at 1.8 times price to book, which is the target on SBI, it's still going to be cheaper than an HDFC Bank, an ICICI Bank, or a Kotak Mahindra Bank. Now, asset quality for SBI is now better than peers like an HDFC, ICICI, Axis. SBI's net NPA is at 0.39, better than HDFC at 0.42, better than an Axis at 0.42. So, why restrict the target multiple at 1.8? Is there, I know you laid out 2-3 things which still concern you, NIMS, etc., but is there a case that SBI now becomes the best performing bank from here on?
Garima, if you look at from that perspective, even all the public sector bank has performed far better than what the counterpart in the private sector banking space has done. What happened 10 years back because of the NPA concerns, this multiple re-rating has happened multiple times. So any public sector bank was hard to command even a one-time price to book multiple. However, the things have totally changed, and you have rightly pointed out the asset quality is far superior right now. But I think the street will take its own sweet time. They want to see this growth rate of 15% plus on advances likely to be maintained. I mean, 1 or 2 quarters more. And then I think it will merit a very strong case for re-rating. So around 2 and 2.5 times. The other important aspect of about all public sector banking space is the CD ratio. So SBI still has 82% CD ratio, whereas HDFC is more than 100. So but that is the elbow room which these banks are having for the growth equity going forward. So I'm also hopeful. I'm on the same boat as you have suggested. That things should change, but a couple of quarters more to go. If consistency is there, then definitely 2.1 times should be the going run rate for the price to book multiples.